welcome to Capital Gains Tax, which looks at Chapter 12. And in this chapter, we're going to be looking at how we calculate this tax, which basically arises when we've got a chargeable disposal of a chargeable asset. So an example of that would be a piece of land or some shares, but we're going to see that it does cover lots of different types of assets. And what it does involve is that there are different tax rates and allowances that apply to capital gains tax, so it is different to income tax. We do need to consider what the level of the income is, to consider what rate it is, and often we need to think about what type of gain it is to consider the rate. So we're going to look at all of this in this chapter, but first of all, let's think about what capital gains tax is. So in simple terms, it's where you sell an asset. So if you sell an asset and the proceeds are greater than the cost, then it results in you making a profit, which we refer to as a gain. So this gain may be subject to tax. Now, what I want you to think about is that with capital gains tax, it arises when you have an individual. So an individual can have income, we looked at in the first booklet, like employment income, profits, interest, dividends, etc. And all of this will be subject to income tax. But if an individual makes a gain, i.e. they sell an asset at a profit, then they will pay capital gains tax. And that's what we're focusing on in this chapter. Individuals that sell assets, make a profit, what tax should they pay? Now, what I want you to remember is that a company can also make a capital gain. So a company could sell an asset and they could make a profit, but with a company, all income, so no matter whether it's just a profit or some interest or whether it's a gain, all income is subject to corporation tax. And that's something we'll look at in later chapters. So a lot of what we're doing in Chapter 12 will equally apply to a company in terms of how the gain is worked out, but it is subject to a different types of tax. So this is all focusing on an individual. Now, the next thing to point out is that you will be given some information in your rates table, so make sure you're familiar with these. So these are the tables that you were given in your Week 6 assessment. You've got them at the front of both of your booklets. And the information that we give you regarding capital gains is that there are two rates for two categories of gains. So there's a lower and a higher rate. And we're going to see in this chapter how we define what rate to actually use. So residential property is basically a house. So if you sell a property, maybe you've bought a house and you've been renting it out and you decide you want to take your money out of it, then that would be classed as a residential property and it could be subject to 18 or 28%. Any other gains that you might have, things like selling another building like a warehouse, they will be subject to the normal rate, which is 10 and 20%. Now, the annual exemption that's quoted there of $12,000, this is a bit like your personal allowance. It's the amount of gains that you're allowed to have before you start to pay tax. So all individuals will get this annual exemption of $12,000, and we're going to look at how to use it in the most beneficial manner to reduce our tax liabilities. And then finally, there's some information about your entrepreneur's relief. This is something we'll do in the next chapter when we look at ways of reducing our tax liability, but we'll do it in more detail. But just to mention at the moment, it is a lifetime limit of 10 million, which allows you to pay tax at the lower rate of 10%. So let's have a look at what sort of things cause capital gains to arise. The first thing to remember is what is a chargeable person. So this tax, remember, only relates to individuals, particularly individuals who are UK resident. There are other categories that you've got there, so partnerships, trustees, but that's a little bit beyond what you're doing at the moment. So just focus on the sort of basics here, that we're dealing with an individual selling an asset and they're UK resident. So as long as the asset they're making is a disposable asset that's subject to tax, then we're going to have to calculate it. A non-chargeable person, well, we've got some items listed there, and the main one to focus on is a charity. And use your logic here. If somebody dies or somebody comes into some money, say, and they pass an asset on to another person, you know, it might potentially be subject to taxes, But if you're going to give anything to a charity through any sort of situation, it's unlikely the charity is going to get taxed. I mean, they're not going to want to keep the property. They want to sell it and get some money out of it. So it'd be very unfair if somebody left that to a charity through various means and then the charity had to be taxed on it. What is a chargeable disposal? Well, there are a number of situations that can create a chargeable disposal. The main one is selling all or part of an asset. And you might think, well, how can I sell part of an asset? Well, part of an asset could be a piece of land. You might buy, say, 20 acres of land and you just want to sell, say, 2 acres. And you can't just say, oh, well, it's 2 out of the proportionate total, because all the land might have different values depending on, you know, where it's positioned, etc. So we'll look at that in more detail when we get to a part disposal, but just to bear in mind that you don't have to sell all of an asset to create the gain. It can be part of it. The other items, again, are a little bit beyond what we're doing here, but bear in mind that if you do gift an asset, and gift doesn't always mean give something away for free, it can be give something away cheap. So, you know, it might be worth 10 grand and you give it away for 7, say. It can be a loss and destruction of an asset. So let's say an asset was destroyed in a fire and you had to pay out of the insurance company, or even exchanges of assets. So lots of situations cause gains to arise, but we're mainly focusing on A in this chapter. And again, it reminds us of the non-chargeable disposals, which we've got there, things to do with charities, anything caused by death. I mean, death might create a tax, and we'll look at that when we do inheritance tax, but it doesn't create capital gains tax. And something else which is mentioned in this chapter, transfers between spouses and civil partners. So if husband and wife, say, want to transfer an asset between them on paper, so they fill out the various documents, then they're not going to be subject to taxes. So the majority of assets will be chargeable assets, provided it's made by an appropriate person in an appropriate situation. The most common examples are there, and the ones that we will see the most often are probably A and F. So selling land and buildings, and F, which is a chattel. Chattel, tangible movable property, something you can physically see and touch and move it around, but it is only chargeable if it's bought and sold for more than 6,000. So, you know, we've got lots and lots of chattels that we might buy and sell, and if we didn't put a limit on it, this would be a logistical nightmare for the HMRC. So they're only really interested in the big sums of money, which is why they've got that limit on there of 6 grand. So you may see the others in the middle. You know, you might sell some goodwill, which is like your reputation of your company. Probably looks at goodwill a little bit when you did groups in financial reporting. You've probably mentioned leases briefly, shares in a company. You know, if you've got some shares in British Telecom, you sell them and make a profit, that could be chargeable. And then we've got the unit trust. But A and F are the most common scenarios. You do need to learn what is an exempt asset. So similar to what you did in income tax, if you've got a situation where somebody is selling something that's exempt, you need to say in your answer that it's exempt. You're not going to get the marks if you just ignore it. So for example, in income tax, we might have had an ISA or you know, something similar, but we had to say in our answer, didn't we, that this item is exempt, or indicate in some way that it was exempt, and that was the reason why you weren't doing anything with it. So the first 4 are probably the most common. So cars are always exempt, and this does cover all types of cars. So it could be your bog standard sort of Ford Fiesta, or it could be a Porsche, or it could be a limited selection, you know, of a classic car, but they are exempt. But what isn't exempt is if you've got a personal number plate. So personal number plates can sell for quite a lot of money on the DVLA or on the open market. So if you do sell them and make a profit, it may be subject to capital gains tax. Then we've got the main residence. So this is where your home is. You have your main home that you live with your family. If you sell this, so let's say your parents want to move house and they sell it and make a profit, they're not going to be too happy if the taxman wants some tax on that. So as long as it's been your main home, you've not used it for business purposes or rented it out or anything else, then that will be exempt. Then we've got the chattels. So this sort of links to what we had above. So chattels above 6,000, if we buy and sell them, are chargeable, but below are exempt. And this is the sort of thing, if I've got a small sort of cheap piece of jewellery that I sell, I suppose it may not necessarily be cheap, but I buy and sell it for less than £6,000, the tax man's not going to be chasing after us for the capital gains tax. Whereas, if it was an antique piece of jewellery that was worth a lot of money, then they would be interested. For number 4, a wasting chattel. So this is still your tangible movable property, but it's things that have a life of less than 50 years. Now, normally in exam questions, this will be things like live animals. So horses might sell for quite a lot of money. So they will be exempt in this situation. But, just look at the question and see whether you can justify whether it's going to live for less than 50 years. So if it's an animal, clearly it's not going to survive that long. So there are some other things there which you can sit and have a look at, but those are the most common ones that we're going to see. All right, so we'd look at the disposal, work out what we've got in that situation and see whether the asset was going to be chargeable. So I'm just going to run through this first example and sort of explain what's happening here, just to give you an idea of what sort of things you're going to see. You're not going to get something like this in the exam, you're not going to get a tick box, but obviously you will be given a situation where somebody sells a number of assets and you need to know whether it is going to be subject to capital gains tax or not. So the question is asking us, which of the following disposals might give rise to capital gains tax? So remember, when we're talking about capital gains tax, we're only dealing with an individual who is selling a chargeable asset. So for the first one, we're selling some property. Now, a property is a building, which is a chargeable asset, but it's being sold by a company. So the company may well make a gain on that sale, but it won't be subject to capital gains tax because, as I said at the beginning, companies are subject to corporation tax. In the second scenario, the gift of shares between husband and wife, that's the key thing. Any transfers between husband and wife are exempt. They will just transfer on paper between each other. We're not going to be charging capital gains tax to husband and wife. Assuming, of course, they live together, they're not going through a divorce, that would be a completely different situation. Then we've got a transfer to a charity. Charities are also exempt. They do not pay any tax. The same would apply for D. We're dealing with a charity. So all of those first 4 would not be subject to tax. And let's be clear, it's not the type of transaction, it's not the type of asset that's making it exempt, it's who is making the disposal. So the first one was a sale. All right, and it was dealing with a property. A property is a chargeable asset. For the second one, we were dealing with shares. Shares are a chargeable asset, and a gift of shares might give rise to capital gains tax as well. C was another gift, but it was dealing with a painting, and a painting is an example of a chattel, tangible, movable property. So if the gift had been by an individual, then it may have been subject to tax, but because it's a charity, then it will be exempt. And then the D that we looked at is the same scenario, but it's dealing with a sale. So I want you to be clear that the type of transaction would make it chargeable. If I sell or gift something, it may be subject to tax. And all of those assets, the property, the shares and the painting, are all chargeable assets. What is making it exempt from tax is the fact of who is making the disposal or who's receiving the asset. Now, when we look at E, we're dealing with another sale of another chattel. So again, it's looking like it might be chargeable. However, the person that's making the disposal is an art dealer. Now, if they're an art dealer, they are conducting a trade. So it's not going to be treated as a gain in this situation, because what they're doing is they're trading as someone buying and selling paintings. So their sales for the year will be the proceeds from all the sales of the paintings. You deduct all their costs of running the business, and then they'll end up with profits, which will be subject to income tax. So that is exempt because you're dealing with a trading activity, not an individual to an individual, and therefore it's subject to a completely different tax. Whereas when we get to F, F is chargeable because we're dealing with an individual who's part of a partnership. Partnerships are a collection of individuals who get together in order to have a view to making a profit from a similar idea. So when the partnership sells the oil painting, you work out the gain, and then this will be allocated to the individual partners accordingly. For G, this is another chargeable one because we are dealing with an individual. It doesn't matter that it's a gift, remember. An oil painting is a chargeable asset, and as long as it's being disposed of by an individual, whether it by selling it at market value or gifting it cheap, it's still going to be chargeable. And the final one is also chargeable, dealing with the same sort of asset, but it's to do with destruction. All right, so destruction, because you've had a fire, can sort of create a capital gain. So the main things to remember is that any of these situations here can create a capital gain. Selling the asset, gifting it, destructing it, or exchanging it. All right, so bear that in mind. What sort of thing is taking place? Is it a chargeable asset? Is it something that would normally be exempt, like a car? Or is it an individual that's making the disposal, or is it a business? So, you know, think of type of disposal, type of asset, and who sells. All right, try and think of those three things when you're looking at a transaction. So if you're happy with that example, then you can have a go on your own at example 2.2 for homework. And remember, all the answers to these examples can be found on Moodle if you look at the capital gains tax section.